Welcome to this short video on project financial forecasting. Project financial management is for project managers much more than simply managing a spreadsheet with numbers. It's a way of trying to achieve the perfect balance between project investments and the expected outcomes or benefits from these investments. We call that return of investment. If working in a portfolio managers group or team, you'll be finding yourself spending a lot of time capturing the financial data from the sum of all projects below you, and then balancing those sums against the drivers and the priorities for the company you work in. To get us started, you might have heard about the word Capex before, and Capex is a cost category for it, as an example, buying machinery, equipment, intellectual property, or software. Quite often you'll see that you set up a cost structure, or the company already has one, where at this level you'll have different categories that are all related to the Capex. So by entering some values here, you'll find that this is then up here turned into the sum of Capex, so the capital investments. You might also see what we call Opex, the operational expenses. Again, we have different sets of cost categories for Opex, and those again you will probably find down here somewhere. And again, all of them added up to this number up here. So altogether, this could be the breakdown of Capex and Opex, and rolled up that would equal to a project cost or an investment proposal for $100,000, for instance. Now, this would at some point, if approved, become the approved budget. And the approved budget is the first approved budget. You might have different approvals later on or in the future, but this is the initial budget from which we'll try to calculate the business case. At some point in time, the project is under execution and you will find yourself tracking actual cost. Now, actual cost is again trying to capture what we have spent on the same categories as we just had the budget defined at. And obviously rolled up so we could compare the budget and the cost constantly and over time. Estimate to complete is not actual cost minus approved budget. It could be if you're lucky, but quite often this is the revised number where the project manager has said, well, I had 50,000, I spent 35, but I think I need to spend 30 more until I'm done with this project. So this is the revised estimate to complete. So it's not just a simple matter of budget minus actual cost. Now, because we have a revised estimate to complete, or ETC, and the actual costs, we are then able to combine those two and come up with what we call the forecast. And the forecast is then comparable to the approved budget, which gives you a variance of plus or minus for each cost item, and obviously also rolled up to the total cost variance. In this case, minus $15,000. So we are overspending from a forecast perspective in terms of the latest approved budget. So if we wanted the variance to go back into a zero, we would have to go back to the approved budget and request $15,000 more. Now, for some, it's not enough to simply work the numbers on the total level. You would have to time phase them at least in the years as we close and open different financial years. Again, you would then have to manage the cost, so the approved budget, and spread that out across different years. And then later track, let's say, actual cost 2017. And obviously that number in January would be quite small, but at the end of the year, probably much higher. So each month or each quarter, you would have to go in and revise that number and track it into that detail level as required. You would do the same thing with the estimate to complete. In this case, we won't have estimate to complete in the past. So once a month has ended or a quarter, we should have a zero in estimate to complete, and the actual cost should be the real value for that particular month. The forecasting we will still have, allowing us to forecast how much money we are going to spend on the project or the initiative before the end of the year or at the end of the year. Same thing applies for 2018, and again we should probably also work the totals, which is the number we'll be using for tracking the overall investment and the business case. So here are some basic examples. You allow, let's say, your son or daughter to go out and buy a video game. They are allowed to spend $500. They end up spending $450. Because this is a one-off investment, they will have 0 on the estimate to complete. No more money is needed, which brings the estimate or the forecast to 450 USD, which is 0 plus 450. So this is $50 less than approved, which in this case gives us a positive of 50 USD. So we are happy. Now it could also be a matter of going out and buying shoes. So that could be kind of like a portfolio. So for all of 2018, you're allowed to buy shoes worth of 1,000 USD, this number. And currently we have spent, let's say, 700 USD at half through 2018. But we have an estimate to complete at the same number, also 700 USD. And if we add those two together, we get 1,400 on the forecast. And if we compare that to the 1,000 approved, we have a minus 400 USD. So we are not happy. And obviously, from a portfolio perspective, if both should be tracked at a higher level, you would roll up all the information and also have a drill down capability. So you could find that you are on the total cost level short minus 350 USD, but it is not because of the video game, it's because of the shoes. So when it comes to benefits, ROI and payback, well, benefits is something we should track as we do with project cost. We should at least, to start with, define it by years and not by totals. So trying to see when the benefit will come back to us as an organization from the investment we did. So if we look at the project cost level, we again have something called year 1, 2, and 3, but we also have something called year 0. And all of these years are generic because we don't know when the project will start. So once we got the approval, then we can try and go in and define the real numbers or the real financial periods rather than just these generic numbers up here. But here we have a project right now with a total cost of 1 million USD, and we are planning on spending 650,000 in year 0, so at start on the first year of this project. Now we call this year 0 because we are probably not going to gain any benefits in the first year that we do this project. We could do, but in this case we're not. So in year 0 we are planning on getting $0 in return on this investment. It's just a cost for us. But in year 1 we are planning on a total sum of 600,000 in benefits from growth and reduced administration costs. And that all rolls up into a total benefit of 1.8 million, which is obviously then later compared to the 1 million in cost. So the ROI in this case would be 0.8. That would be the benefits minus the total cost and divided by the cost. So 0.8. Now when it comes to the payback time, in this case we have below at the plus and minus level right here, taking the minus 650,000 in the first year, that's the loss we have at the higher levels. That would be all of this together, minus 650,000. In year 1, we had 350,000 in plus. Again, that would be all of these numbers together, where the cost would be a minus, like this on all of them. In year 2, same thing, minus 250, minus 250. Up at the top, and compared to the benefits, all of these have the same 350,000 in total cost when it comes to plus and minus. So that's a plus. This brings us up to a cumulative view where we can see that it takes us more than 1 year and this year and all the way until year 2 before we actually have a break even. So in the first 2 years of this project, it will be a loss of money or a cost more than a benefit for the company. But from year 2 and forward, it will be a plus. If you show this in an Excel chart, you'll see that the break-even point right here is just before year 2. It's probably at around 18 months or so. You'll see, or 20 months something, you'll see that this project has paid itself back again and will then drive a profit going forward. It's worth challenging internally in organizations whether or not you should plan with benefits in 3 years, 4 years, or 10 years ahead in time. That's all a matter of the type of project you're running. Let's say if it's an R&D project, it's typically very long term. If it's an IT project, it might only be 2 or 3 years ahead, and so on and so on. So this concludes the presentation. So I hope you enjoyed it and learned a little bit about project financial management.